Good morning and welcome back to the latest edition of the InvestTalk Market Analysis for the week ending December 1st, 2023. Appreciate you all tuning in. I'm host Justin Klein, and yep, it is December. So only 1 month left in the trading year, and then 2024 is upon us and probably brings a different market. And you're starting to see that different type of market reemerge. So we're going to dig into the details and the charts here in a minute, but I do want to remind you to like and subscribe to this channel as well as our podcast, Invest Talk. Now, the economic data this week: new single family homes sold that did level off in the month of October. Remember, these are a little bit lagging, so you'll probably get some strength in the housing market in November as rates did come down. So, this was kind of peak interest rates where mortgage rates were in some places approaching 8%, depending on who's borrowing. Pending home sales year over year did improve, though, despite that. So it shows you how base effects can impact what that looks like. Richmond Fed Manufacturing Index, that did tick down. That is November, so that's a little bit more live. And then the big number was the inflation data for the month of October. Still a bit lagging, but it's what we're seeing. And the PCE price index, remember, this is the Fed follows, is mainly the PCE, not the CPI. And that is the lowest level in 2.5 years, since the spring of 2021. So it's pretty clear that inflation's dead, especially when you consider the vast majority of this increase is on the rent side. The what's called owner equivalent rent, it's a very lagging indicator, the most lagging of these, because remember, rents are usually signed on a 12-month basis. So this is including rents that were signed 11 months ago. And obviously, the housing market or the rental market continues to see new supply coming on with a lot of apartments coming on, and just new supply of homes. And so you're starting to see, especially in the kind of the high cost regions, rents are actually falling. But that is not fully reflected in this data. So if you look at more of the short term basis, 3-6 months, inflation is much closer to that 2% level. And it's pretty clear the Fed is done. Construction spending, that was on Friday, and that was a tick up. So that was a positive. Well, once again, that's October. But really, this is all about what the Fed is going to do. We have the Fed meeting in a week and a half. There's a basically 100% chance that we're going to get a pause. Same with January. Only a 1% chance that there'll be a rate hike between now and the January meeting. So over the next basically 2 months, because this is January 31st, is that first meeting of 2024. But a 14% chance we get a rate cut by then. I don't think we will, but that's certainly what the market is starting to price in. And now the best odds are the first rate cut coming in March, the end of the first quarter, March 20th. 55% chance of one cut by then, and an 8% chance of two cuts. So about a 2/3 chance that we'll get one rate cut by the end of the first quarter. May is where the market is pretty priced in that there will be at least one rate cut. If you combine all of these, you're talking about a 90% chance of a rate cut by May. And obviously that is feeding into the dollar. Here's the dollar peaked back late last year. You had the weakness in the dollar, pricing in a potential Fed rate or Fed pause, and that throughout the year kind of was faded because the economic data continued to come in relatively strong. Only recently are you starting to see, the jobs market break and some of the economic data really reflecting the lag effect of monetary policy tightness that started last year, and it usually takes roughly 18 months for it to start to really feel in the market and the economy, and that's what you're seeing now. And that's why you're likely to see economic data continue to decelerate into next year, and a recession at some point next year, a mild one, but that also doesn't mean we're going to go to hell in a handbasket as well in the equity market. So a lot of people correlate a recession with a major drawdown in equities. It's not always the case, as we talked about in our webinar just a few weeks ago. But the dollar has rolled over, and we do think we're in a kind of a longer term downtrend in the dollar, which should help the commodity side of the market. And what's interesting is that usually into year end, you get a continuation of the trends that are in the market throughout the year. And throughout this year, growth has outperformed. let me zoom back out. This is the S&P growth versus S&P value. This peaked at the end of 2021 as rates bottomed, right? And you're starting to see this rollover again. All throughout last year, growth underperformed. Nasdaq was down 33%, and the value side of the market was down modestly. And so you had that huge shift. Now, this year, you've had a snapback rally, but what you can see is the longer term trend is still down, right? We're not breaking above the summer highs where we got a kind of that counter trend growth rally last year, and then into year end, obviously, it was grinding to new lows. So until you see this trend shift, you still kind of have to lean on the value side of the market, especially now as this trend is starting to reemerge. Look at this. We're now below all the major moving averages except for the 200-day, and that's threatening. You see this MACD below the zero line. That is starting to create a trend. Value is starting to outperform once again. That's why I talk about the Mag 7 is lagging. Here's the VTV, the value index. Look at that surging here, and that's on the back of industrials, highest levels since August. Look at financials. Obviously, they were hurt from higher interest rates, and that has helped them rally here. If you look at the TNX, this is the 10-year. Obviously, that has reversed in a big way. 5% 10-year just in the middle to latter part of October, and now we're into early December, and we are at 4.25 on the 10-year. And now, long term, you're probably going to see rates grind higher. But let's go to monthly chart. This long-term downtrend has reversed, but could you see a pullback, into the low threes? Would not shock me to see that, especially if you go through a Fed rate cutting cycle. I still think the trend long term is higher, but this is, I think, the start of your pullback consolidation period with rates getting some downside, and obviously the value side of the market certainly improving. So I wanted to highlight that because it's very important to see these trend shifts that are going into year end. Here's the gold to S&P. That's starting to get a perk up as well. So gold is breaking out. Look at this, the highest levels this year on the GLD. I think we're approaching 2,100 on the gold price, and the GDX that's breaking out as well. This is a reverse head and shoulders. We had that downtrend from the highs of earlier this year, and that broke to the upside in October and consolidated, and now we're getting a break to the upside with a reverse head and shoulders. Here's one shoulder here, another shoulder, and here is the head. What you do is you measure the head to the neck, and you copy that, and you put that where the breakout was just this week, and that was on Tuesday, and this has a measure move up to about 34 and change on the GDX, and likely to break out to new highs as we head into 2024. Probably doesn't hit new highs this year, but probably sometime in 2024. So that's what you're seeing there. You're also seeing a breakout in the small caps. Here's small caps to the Qs. That's starting to get a big move on Friday, huge move, and I think that is something to watch out for. Let's look at the Qs. That's part of this rotation here. Look at the Qs, just kind of went sideways on the week, and here is IWM. Right, that surge on Friday on the breakdown in the in rates. And let's look at the Mag 7. Right, here's Tesla, kind of now in a downtrend. You see not a strong downtrend, but certainly a series of lower highs and lower lows, and not breaking out with the rest of the market. Amazon, it's another one that is kind of just chopping sideways, still near new highs, definitely much better than Tesla, not in a downtrend, but sputtered this week. You have Google or Alphabet. That one did roll over a bit this week and starting to threaten a downtrend, not getting to new highs, right? Lower low, now it looks like a lower high. That could be in a downtrend, especially if you go in a softening economy. The advertising stocks, which Google is, could see some downside. Meta as well. Certainly stronger than Google, but that's definitely had a weak week on even with broad equities rallying. You look at Microsoft, another one. That one certainly stronger, but definitely had a flat to down week. Apple looks like the strongest kind of near term consolidation, but that one is certainly underperforming kind of the broader market this week. What else are we missing? Netflix, I don't think this is necessarily part of the Mag 7, but that is definitely rolling over. NVIDIA is certainly part of that new Mag 7, and that one has had a tough couple of weeks here, now threatening a downtrend. You look at something like the broader SMH, and that is having trouble at these new highs as well. So you're seeing that rotation out of growth and into value into new year end, which is pretty interesting to watch. Let's take a look at the credit markets. So short term, always look at this short term junk, the short term treasuries, and that remains strong. So you're not getting a credit event, and that's why equities remain relatively robust. Some sectors, utilities getting some strength on the back of the rally in the bond markets. Remember there, that is a bond proxy. Okay, and so you're going to snap back there. Commodities are not following through with gold. So what you're seeing is oil on the back of the OPEC meeting. They cut production, but oil didn't get a huge rally there. So I think for now, until there's some clarity on how weak the economy is going forward, oil is kind of stuck. It's kind of neutral now, not bearish, not bullish. We'll see what kind of breakout we get one way or the other into year end. The XLE definitely a little bit stronger than the oil prices on the back of value really breaking out. The MOVE index, the treasury market, that remains down around 111. So not many problems there. Obviously above 150, that's a problem. Right now, no problems there. The VIX down around 12. So that is obviously bullish for risk assets overall. And that's what you're likely to get into year end. I think a continued rotation. Here's the NYSE that's threatening back to new highs. Look how strong this move was. A more hawkish Fed is certainly bad for asset prices, and it's pretty clear now the Fed is no longer on a path towards hiking rates again. Just a question of how dovish will they be. I think that the market probably is getting a little too optimistic on a Fed rate cut by the end of the first quarter. I think that's going a little too far, but a lot of this has to do with positioning. People are positioned so bearishly on treasuries. Just look at the TLT, and that's gotten a nice rally here. And once again, that can be short covering. That can be a big reason for that. Here's the IEF also getting a rally. So these are all longer term treasury ETFs. So you're likely, once again, to get that float into year end as people kind of catch up. This has been a pretty strong snapback rally. You're overbought. You're approaching those new highs. That's going to be resistance. Could you see a pullback between now and the end of the year? Sure, but it'd probably be very shallow, right? You're at 4,600. Our base case, I believe, was around 4,500 where we closed the year. So could we see some modest downside? Sure. But I think this is more kind of consolidation period into next year. Remember, as we get into the holiday season, you tend to finish the year as the rest of the year has gone. Meaning if the rest of the year was up, you tend to be up into year end. If you were down, vice versa, right? Now, what's interesting here is you had tax loss selling into last year, and I think there's still potential for that, especially in the growth side of the market, because if you go look at ARK. People that didn't do tax loss selling last year, they still have the opportunity to do that this year, right? Even though they're up for the year on a lot of those names, they're still down because they bought. I'm looking at ARK here, way back in 2021, chasing the big tech stocks, et cetera. So maybe that's a reason for this year end kind of rotation. But it's very interesting to see that this is kind of sputtering, right? The growth side sputtering as it attempts to break out, whereas the value side, that one's getting that resurgence. So that's really what we're seeing. Precious metals breaking out, like I said, Mag 7 sputtering. That's why I titled the video as such. I didn't get to this. So over to gold ratio, that one is breaking out. I talked about how this needs to reverse. This needs to get back into an uptrend, and we broke out this week above this downtrend line that we've seen, since the highs in precious metals. So if this can be just a consolidation kind of wedge pattern that breaks out, that would be positive for precious metals as well. I think that's it. I think that's what I want to get to. That's the main message here. As we go into 2024, that long-term trend of value outperforming growth is likely to reemerge. And you're going to get periods, even though rates are higher, even though the economy can weaken, you're still likely to get that longer term trend of value over growth, right? Let me revisit this because some people might not have heard it. Go to a monthly. This is growth to value. So when this is going up, growth is outperforming. When it's going down, value is outperforming. This is 2000. When dot-com bubble burst, you had basically value outperforming growth until the financial crisis. And then you had financial repressions, rates at zero, cost of capital next to nothing, everybody crowding into tech stocks, and valuations ballooned. And especially during COVID, when there was work from home and everyone was extrapolating growth and rates were back to zero. But that reversed. And there are only two times where growth tends to outperform over the last 130 years, and that is during the 1920s and the 2010s. So in a normal market with a cost of capital of something, value is likely to continue to outperform. I know we had a few quarters here where that's not the case, but this is just actually a bearish wedge. Look at this quarter. From fourth quarter last year, we didn't even break above that quarterly high, and now we're rolling over again. That's called a bearish flag, and that's basically what you've seen. So I urge you, reassess your portfolio. If you do want to do a portfolio review, you can do so with me. Just head over to our website, investtalk.com, click on the button on the top right, and we can assess your portfolio and help you understand how you are positioned. All right, I think that is it. Appreciate you all tuning in and liking and subscribing to this channel. Reminding the contents of the video are for educational purposes only and should not be construed as a recommendation to buy or sell security or to participate in investment strategy. The views are my own and do not represent those of KP Financial or those associated. Have a wonderful weekend.